Awesome.
Hey there, happy Thursday. Let me do a quick introduction just for people who may not know at this point.
Yeah.
I'm Leslie Vitel with Keller Williams Realty in the Jacksonville, St. Augustine area of Florida, and you are Aaron Bacus with First Coast Mortgage Brokers. Well, First Coast Mortgage Funding,
Funding.
which is a
Yes,
broker,
exactly. You
also
got it right,
serving.
Leslie. Good job.
Yeah, they are also serving the same area. But we're talking today about something that's really exciting and really timely for the market,
Yes,
which
yes.
is if you've got a house to sell, how do you buy a house before that house sells? Things are sitting on the market a little bit longer. We're in a different scenario these days. And people still, I know mortgage applications are up. We anticipate that a lot of those, based on what the stats that I'm hearing, a lot of those are people that are ready to move. So they're applying for a mortgage, making sure they can qualify ahead of time, which means they've got a house to sell before so this is timely.
Yeah, no, absolutely. I'm very excited to talk about this because this is a very popular topic for multiple reasons. It's always kind of a popular topic because whether somebody can sell or they can't sell in a timely manner, a lot of people don't want to move. They don't want to move twice. So they want to buy and then have the time to fix it up or new carpet or whatever, and then move their stuff over, not go to a storage unit in between or apartment, whatever the case is. So
Oh
it's
yeah, and
twofold.
coordinating that stuff because trying to get
Yeah.
that stuff coordinated and make that work for everybody can be extremely challenging if there's a
Exactly.
house to
And
sell.
we
Yeah.
all love the process of moving and moving our stuff and all of that. So fun. So we want to do it once. So let's talk about that. So, you know, when you want to buy before you sell from a lender point of view, there's two things that come up. Number one, can you on paper afford both mortgage payments? Can you afford the payment of the house that you're living in now? And can you afford the payment of the new house? And a lot of people say, well, I'm going to sell this in a couple months. I'm not going to have that payment. That's absolutely correct. And it's going to happen. But from a lender point of view, when you close on a loan, you have to account for what the debts are at that time. So whatever you're going to do with your current house, we have to count that. So that's the number one challenge is like, can you qualify with both? And then the second challenge is where are you going to get the money to close on the new house? Whether it's down payment, closing costs, whatever. Those are the two big challenges.
Yeah, because
And
that's usually coming out of the equity of the house you're living in, especially if you bought 5, 6, 7 years ago. You've got a good amount of, we're just a little bit of a softer market, but you're still sitting on a pile of equity probably.
no question about it. And if you're using that equity towards the new house, like how do you do that without selling the other house? Well, the great part about it, there's more solutions and options than there's ever been to take care of that problem. So the two major problems from a lender is qualifying for both mortgages. And then also, where do you get the down payment money if you don't have another source of that down payment money? So let's go through the list. So the first one is there's multiple home to sell options out there. What I mean is there's services that offer a service to guarantee to buy your house after a certain period of time. So the way that would work is they would evaluate your house and they would give you a guaranteed sale price over a period of time. And there is a charge for them to perform that service. Okay. So that may not be the best price that you can get, but at least it's a guarantee and that you know that you have a backstop.
Mhm.
And there generally is a charge for that. So, from a lender's point of view, what makes it really good with a program like that is that their certification allows us not to count that debt against you in your debt to income ratio, which is a huge deal to be able to have that certification that I don't have to count that debt. So many people on paper can't afford to have both payments and qualify for a new loan. This option really helps that. So there's a lot of cool things about that option. You can still proceed forward with the normal marketing and selling of the house with the realtor you're working with. And you have the 6-month time period to happen. And most of the time it sells in that time period anyway. It just kind of gives you kind of an insurance policy that what if that doesn't happen? So one thing too that we lose track of, Lesley, just because they can afford it on paper, you got to make sure you're comfortable with doing that. If your mortgage payment is $3,000 over here and your new one's going to be $4,000, are you comfortable with paying $7,000 for a couple months? That's something you got to be comfortable with. And that also comes down to the certainty of selling your house. So that's option one. Does that make sense, Lesley?
Yeah, absolutely.
Okay. So it's a great option for the lender to be able to not count that debt. And then also for the owner to have a certainty of here's my lowest denominator in a period of time that I know will happen. So that's number one. So number two is a HELOC on your current house. So this is a big one. HELOCs have gotten to be a lot easier and faster to obtain. We offer HELOCs. We do them very fast. What I always recommend with HELOCs is many options allow you to set up a HELOC, which is a home equity line of credit, whether you need it or not, whether you're going to use it or not, because that way it's just sitting there waiting for you to use, whether you want to use it for a down payment on a new house, whether you want to buy a car or a pool, whatever, it's always there for you to use. But a home equity line of credit can be used as down payment for the new house. Okay. So you have a second mortgage, a HELOC on your current house, and you're using that money to make a down payment on the new house. What's very important about that, Lesley, is that you want to establish that HELOC before you put your house up for sale.
It's very important. Yeah, that's a very important note.
It's very important.
Yeah, because the order of operations here matters. No one wants to do a HELOC for you on a house with a sign in the yard.
Exactly.
That's a hard stop because they are going to send out somebody at least to eyeball that property. Like they're going to want to know. They're going to Google it. Like all you got to do is Google it when it's for sale.
Exactly. A very good point. And that's why I kind of recommend having that anyway. And for those of you who don't know what a HELOC is, it's basically a credit card on your house. Just think of it that way. Let's just say you had, $200,000 in equity. They may give you a credit card for $100,000 that is a second lien on your house that you can use, pay off, use again, pay off, use again. Same thing as a credit card, but it's just attached to your house.
And when your house sells, that'll get paid off, and that line of credit will close.
Exactly. That's a really good point because it is a lien on your house. So when you sell it, it'll be paid off. So let's just say you needed $100,000 from it for a down payment on your new house. That gets paid off when the house gets sold, just like your first mortgage. So that's something to have in place before it's listed for sale. Heck, I think it's something to have in place at all times. I just think it's a good security measure, regardless if you're trying to buy or sell.
And real quick, like what are we looking at for an interest rate on something like that right
now? Yeah, HELOCs are going to be higher.
Credit cards.
Yeah. Oh, they're much lower than credit cards. Yeah. I mean, HELOCs today, our normal mortgage rates today are in the 5s and 6s. HELOCs could be anywhere from 8 to 10 to 11, depending on how much you're going to do, your credit and all that stuff. Credit cards, as we know, are 23%. So, and plus, so it's a much better option to have, as far as that goes. So that's a really good point. It's kind of different levels of what the rates are. So I recommend having that just as available, just as something to have. So HELOC makes sense. Have that ready and you can use it for the down payment on the new house. Okay. A third option, and a lot of people don't know about this, and this is generally for our people that are a little later in their life that have accumulated some assets that may be of retirement age. It's called a margin loan. Okay. So let's just say you have $500,000 of stock in a retirement account that you've accumulated over your life, and you you can go to your broker, Merrill Lynch, Schwab, whoever, and say, hey, I want a margin loan. What it is they'll give you a loan based on the assets you have in your stock portfolio. So you don't have to sell the stock. So let's just say you had a $500,000 in an IRA. They generally give about 50% of that in a loan, 50% of that value. So they'll give you a margin loan, 200, 250,000. There's generally very little to no fees. It can be set up in a couple of days. And your interest rate on that is not that bad. I mean, generally in the 5 to 7% range. So that's something that a lot of people don't know about, that I talk about all the time. That, again, Lesley, we talk about you sell the other house, you just pay off the loan. So right. There's nothing negative about that. And it prevents you from selling the stocks in your portfolio, which may cause capital gains, or you just don't want to sell the stock. So your broker, financial broker, is happy to help you with that, because that usually prevents you from selling the stock that they manage. So that's called a margin loan. That's another way of getting money for a down payment without selling your house. Make sense, Lesley?
Absolutely.
Awesome. What we hear, number 4, is what we hear traditionally is a bridge loan. Okay. We've been hearing that forever. It's a buzzword that we've used forever, and they kind of come and go as far as their availability. But what that is it's very similar to anything else, but it's a specific loan that somebody makes on the equity of your house to give you money to buy the new house. It's a bridge loan. Traditional bridge loans we have found to be kind of clunky, very difficult to get, don't really meet the circumstance as much as you want. But it's really not a whole lot different than taking out an equity line on your current home versus a bridge loan. The bridge loan, they know you're going to sell the house and they're okay with it. They're really willing to give you a temporary loan. So that is definitely a viable option. It's a viable option to do. It's kind of an old school term and method and clunky, but it is something that's available there. So that's really option 4. Keep in mind,
people use that as a general catch-all term for figure out a way to borrow the money to make this transaction happen. But yes. I mean, there is a traditional bridge loan for sure, but I do think people use it interchangeably with some of this other stuff.
No doubt. It's a description that can mean a lot of different things depending on where you are in your situation.
Right. You understand, like, people can hear that and understand, okay, that makes visually, I can see it. It makes sense. Yeah.
For sure. The good thing about a bridge loan is it generally allows the lender not to count the current mortgage payment of how you're selling in your debt to income ratio. Because remember, Lesley, we got the 2 big, elephants in the room from the lender. Where are you going to get your money? Can we verify that for the down payment on the new house? Can you qualify for both loans? Those are 2 of the big things to get you qualified for a new loan. Okay.
Yeah.
So a 5th option, and let's just say that you have no problem qualifying for both loans. You have some extra money on the side. You don't need the equity in your house to do as a down payment, but you really want to use that equity in your house to lower your loan amount and get a really low payment on the new house. No problem. This is a very easy way to do that. So conventional loans allow a 5% minimum down payment. Okay. That's a minimum amount that you can get in. So you can get that 5% from a number of different things. You can get it from your 401k. You can get it from your retirement. You can get it from a gift. You can save it. Maybe it's all one or more of those things. So let's just say you get together that 5%. You still have your current house, haven't sold it. I can qualify for that payment, check. I don't need the equity in that house, check, but I have 5% of my own to buy the new house. Okay, great. You buy the home, 5% down. Now you own 2 homes. Okay. A month later, you sell your current house and then you have $300,000 of equity. Like, hey, on that new loan that I got for $600,000, I want that payment to go down. I want to use my $300,000 and lower that payment. You do something called a recast. Okay.
I love the recast concept. I
Yes,
just think this is amazing.
it's awesome. It's awesome. So what a recast means is you got a new loan to buy the house for 600. You got 300 in equity from what you sold the other house. So you pay down that 600 to 300. And for a very small fee, they'll recast your loan to say, okay, you have this $600,000 loan at 6%, and you have 29 years left. We're going to lower the loan to 300,000 at 6%, or at 3%, or at 6%, the same rate, but a much lower loan amount at 300,000. So your payment goes down dramatically.
Yep.
So you ask, like most people say, well, why wouldn't you refinance? Well, you could if it made sense for you to do, if rates are lower.
Right. Let's assume that the interest rate hasn't changed, nothing. You just want to cut that payment in half-ish. Yeah.
100%. Like if rates hasn't changed or they've gone up, or they may have gone down a little bit, but it's not worth the cost of refinancing the loan, where for $150, $200 you can do a recast and lower your payment.
All right, because
So
let's not forget, there's all kinds of costs associated with a new mortgage, which is what a refinance is. There's a
exactly.
chunk of money that's involved in that, and it has to make monetary sense. That the interest rate has to be low enough that it makes monetary sense to go and do that.
100%. 100%. So recast is something that's around and that's important. You can only do that on conventional loans, not FHA and VA.
Oh,
But
good to know. I did not know
yeah,
that.
yeah, a little tidbit there. But it's an absolute great option. It's a great option because, gosh, I mean, how many times, Leslie, do we hear the story like, hey, I'm moving down from up north, I'm coming here, I can afford everything, I don't owe anything on my house up north, but I want to buy a house down here and I want to use that equity whenever, but I want to buy this one down here first.
Yep.
So that's a situation where the person has no problems with anything. They just
Right.
want, they have the cash, they can qualify. This is just a way, like, yeah, take out a $500,000 loan and pay it down whenever you sell your house. So it's called a recast. It's a great option.
Yes.
Another option that we have is called an asset qualifier. So what that means is it's kind of similar to, well, it's not an asset qualifier. Let's just say I have $1 million in the bank. Okay. I'm retired. I'm on a limited income. I don't show a lot of income on paper because I don't have a job. I'm retired, but I got $1 million in the bank. Well, we can do an asset qualifier where we can create an income stream for paper purposes. Let's just say you have $1 million and you wanted to have a $10,000 a month income stream. We can create that to where you qualify for that. And generally, as a general rule of thumb, they want to make sure that you have 36 months of that 10,000 a month to make it feasible for you to qualify. Okay. So if you had $1 million, we said, okay, we want 10,000 a month. Well, 10,000 times 36, 360,000, you've got plenty of money. We just created an income stream. So what a lot of people get worried about, it's like, man, I don't need the $10,000 a month. I don't want it. Like, I don't want to be taxed or whatever. It's cool. It's fine. It's a paperwork thing. All it is like the lender knows that if you needed to, if you had to liquidate that, they would be comfortable qualifying you on that. Does that make sense, Leslie?
Yeah. Oh, absolutely. And that is when you have retirees, when you have people, especially younger retirees, I mean,
Yeah.
I run across plenty of people that are, that age where they've done well enough, they've got the assets in the bank, but they no longer, and they've got plenty of assets, but no steady stream of income. But yeah, people start to get nervous about, okay, how do I qualify for my next house? How do I do that? That's your answer.
It's a perfect thing. It's also for people like, just like you said, they've retired early. Maybe they were a police officer in New York for 30 years and they're 51 and they get to retire. Well, they're moving down to Florida. The spouse, the husband and wife, they don't have a job, but they know they're going to get a job. Like one is a retired teacher, one's a retired police officer. They're not even worried about it, and they can live several years without one. But like, hey, I don't have a job, I really can't qualify, but I got $1 million in the bank. Here you go. Here's your option, and it works great for that.
Yeah, and that's really good for, we have a lot of people that are coming down this way. They're looking at selling their current home and moving into, for instance, an over 55 community
Yeah,
where, yeah, you're not typically buying a house. You're typically, when you're buying a house in an over 55 community, you're not maxing out the mortgage. It's not only 5% down. It's, people are using equity from their current
sure.
homes and things like that. And yeah, they may not come down with a job, but they may be exactly what you're saying, continuing to work, continue to do all those things. They just don't have that plan in place just yet. It's really nice to know they've got the ability to make the move that they want to make. Because
Yeah, for
you can't,
sure.
it's hard to get a job if you're not living here yet.
It
It can
is
be a
for
real
sure.
challenge.
Like, a retired police officer and a retired teacher. I mean, they can get a job easy down here, whatever they want to do, if
Oh
it's
yeah.
similar to that field. So it really works really well for that. So that's an option. And then the last one is let's just say that you have a trust, okay, that you have a family trust. I see this all the time. It's way more common than people think.
It's so
And
depressing that I wasn't born rich.
I know. Well, yes, I get that. We'd all like to have the trust, but sometimes the trust isn't so much about the rich part of it. Is it's more of a functionality of how inheritance were left or whatever. But let's just say that you have a trust, and your dad left it to you or your parents, and you just get $2,000 or $3,000 a month. You get that every month. We can use that towards your income, but what we can also do, assuming that the assets of the trust back this up, kind of like our asset depletion strategy. Let's just say we needed to raise it to 10,000 a month
Mhm.
on your trust, and the trust assets had enough to sustain that for 3 years. We can do that also. We can get the trust to change your distribution, and we can use that as required as income, and that works for the qualification. And what I want to say to people too is it's the same fear I always hear. Like, I don't want this much money per month. I don't want to do. You close on the house, you go right back. It's okay, because the lenders know exactly what this is for. It follows the guidelines. They just need to know that you're setting it up and that you have the capability to make the payment. And whatever you do with it, you're not breaking any rule. You gave them the scenario and the documentation they needed at that time. After you close, you can do whatever you want. Just
Yeah,
make your payments. That's all you have to do.
let's be very clear. This is not mortgage fraud.
Right,
And I
exactly.
say that there's a lot of conversation, in the media about mortgage fraud and what is it. And you see conversations happening. It's like, if you bought a house as your primary house, let just address this really quickly, because I get this question. If you buy a house as your primary house and then you move in 2.5 years to another house, but you keep that house, it is not mortgage fraud to move. It is
No,
okay
yes,
to
it
do
is.
that.
It is okay.
Yeah.
Absolutely. I
And
mean,
that
from
and
a
that question
lender's
is,
point,
for obvious reasons, it's relevant today. It's come up.
for sure, for sure. Well, generally a lender is asking you to do whatever you're saying you're going to do for 12 months. But really, it's really simple for me when someone asks me about that. Like, are you going to rent the house out or not?
Right.
No. Then then it could be a primary residence or a second home. Are
Mhm.
you going to rent it out? Yes, it's got to be an investment property. Where
Right.
people get into trouble is like, okay, I'm not going to rent it out, and then the next thing you know, it's on their tax returns as a rental property.
The
That
next year.
that's
Yeah.
you're misrepresenting there.
Yeah.
So,
But
but
I get a lot of, and sorry, I think I'm derailing us a little bit, but I've got, I get like VA buyers that come in, and these guys are smart and they've got a plan, and they're going to buy a little house here, and they know they're going to get orders somewhere else, and they intend to occupy that as their permanent residence
sure,
for 2, 3, 4 years, and then keep it as a rental. That is the plan that is working it, but they are initially moving into this property as a primary residence.
yes, and
It
that's
is
perfectly
okay
fine.
to move and keep that house and rent it out later.
Right,
As
that
long
is
as you're not
perfectly fine.
fraudulent in your intentions, that yes, you plan on moving into it as a primary residence
For
initially.
sure. For
Yeah.
sure. Well,
All right.
yeah, I'm glad you brought that up. And it's really just that simple. Like, what's your initial intention? But what you described is absolutely fine. So, in summary, let's bring it up. Hey, I want to buy before I sell. Okay. What are the two problems that we face from the lender side mostly? Where are you going to get the money for the new house, down payment and closing costs? And can you afford both mortgage payments on paper? Those are the two things that we have to figure out right up front. And as I just went through, there's multiple strategies that help with both of those things.
Yeah.
To your comfort level or whatever. But you also have to be comfortable knowing if there's a scenario where you have to make both payments that you're good with that too. But there's just so many more options now than there ever has been. So don't let you not selling your current house prevent you from buying another dream house. There's
Yep.
ways to do it.
Yep. And we can, yeah, reach out to us. We can make sure we get you in touch with the right programs, in touch with the right people, and get it figured out. Because we've both been doing this long enough to know that the best thing that you can do is talk to us the minute you start heading down that path of thinking about doing this so we can put together the strategy and you've got time to work it out.
100%.
Yeah,
Always
don't call
options to
us when you
figure out.
found the dream home. It
Yeah,
makes it
right.
a little bit harder. Call us when you start looking for the dream home.
That's right. That's the best way to do it.
Yeah.
But yeah, hopefully that helps some people, some great options out there. And again, love having this conversation, Leslie. Hopefully it can help some people out.
Yeah. Thank you so much. I really appreciate it. This was great stuff. So,
Awesome.
all right.
Awesome. Thank you.
You have a wonderful day.
You too.